On the 16th of October 2014, the Auditor-General tabled his report on the Annual Financial Report of the State of Victoria 2013-14. The Annual Financial Report of the State of Victoria 2013-14, known as the AFR, is the key accountability document for informing Parliament and the citizens of Victoria about the financial transactions and financial position of the state. It is prepared by the Treasurer of Victoria and consolidates the financial results of 279 state-controlled entities and should conform with the applicable Australian accounting standards and with the manner and form as determined by the Treasurer in accordance with the Financial Management Act 1994, or FMA. On the 2nd of October 2014, we issued a qualified audit opinion on the AFR on the basis that we do not agree with the accounting policy used to value school buildings at the Department of Education and Early Childhood Development, or DECD. Specifically, how economic obsolescence is assessed in calculating the fair value of schools. We also issued a similar qualification on the 2013-14 financial statements of DECD. An audit qualification means that the AFR isn't fairly presented in all material respects. Nevertheless, except for the qualification matters, which relate to the valuation of school buildings at DECD, Parliament and the citizens of Victoria can have reasonable assurance that the information in the AFR is reliable and prepared in accordance with the requirements of the applicable Australian accounting standards and in the manner and form as determined by the Treasurer of Victoria. The Auditor-General issued a qualified audit opinion on the basis that, firstly, the accounting policy for measuring the fair value of school buildings, specifically including an economic obsolescence adjustment, is not appropriate, as it does not result in financial information that is relevant and reliable. DECD assess economic obsolescence based solely on student enrolment data, which we consider too narrow. In our opinion, economic obsolescence should be assessed based on whether an asset is delivering the strategic objectives of a public sector entity. For a school, economic obsolescence should be assessed based on the achievement of educational outcomes for the community. Secondly, the assessment of the economic obsolescence of school buildings has not been fully substantiated and resulted in $1.58 billion of taxpayer investments in school buildings being written off as at 30th June 2014. This is despite the school buildings continuing to deliver educational outcomes. We identified that 7 out of every 10 Victorian schools were assessed by DECD to be partly economically obsolete. The approach used in Victoria is not adopted by any other Australian state, despite using the same accounting standards framework. We found that DECD could not fully support the appropriateness of some of its key valuation assumptions for assessing economic obsolescence. The full audit qualification matters, which includes some additional areas of concern, are set out in the AFR audit opinion, which is in Appendix E on page 55 of the report, and discussed in our report, specifically in the audit summary and parts 2 and 4. I will now highlight some of the key implications of the accounting policy adopted for school building valuations. DECD's approach to valuing schools, including making an economic obsolescence adjustment for 2013-14, means $1.58 billion worth of school buildings have been written down as at 30 June 2014. This includes taxpayer funds provided through the Victorian Schools Plan 2007-8 to 2012-13 and the Commonwealth's Building the Education Revolution Program 2007-8 to 2012-13, which together invested $4.4 billion in school building assets. Further, some schools included in current capital works programs or under public-private partnership arrangements, or PPPs, have been partly written off. It is important to note that the state is nevertheless contractually obligated to fully fund the operating, construction and financing costs of these PPP schools over a 25-year period, despite having determined they are partly obsolete. It also means a decrease in annual depreciation charges for DECD. Based on a total economic obsolescence adjustment of $1.58 billion at 30 June 2014, we have estimated that the reduction in annual depreciation could be in the range of $27 million to $40 million using DECD depreciation rates. This has resulted in $27 million to $40 million less depreciation funding each year being provided to DECD for the refurbishment, rehabilitation or rejuvenation of school buildings across the state. I will now highlight some of the key financial results in the AFR as outlined in Part 3 of the report. The AFR reported that the state's net result from transactions, which measures state revenue less expenses, was a surplus of $856.6 million, after having reported a deficit for the previous 3 years. The surplus for 2013-14 includes unbudgeted Commonwealth grants of $1.16 billion. The net result from transactions at the general government sector is a key measure for the state. The government's fiscal target is to achieve a net surplus from transactions of at least $100 million each financial year and consistent with net debt and infrastructure parameters. The net surplus from transactions for 2013-14 was $2 billion, well above the $100 million target. The comprehensive result for the state of Victoria for 2013-14 was a surplus of $7.5 billion. The surplus was largely a result of gains generated on the revaluation of non-financial assets of $5.2 billion, specifically in the housing and health sectors, and a net gain of $1.2 billion on financial instruments at fair value, which reflects the performance of public financial corporations, in particular the Treasury Corporation of Victoria and Victorian Work Cover Authority. An analysis of the state's liquidity shows a ratio of 0.97, indicating that some entities do not have enough cash and other liquid short-term assets to settle short-term obligations. Although the liquidity ratio, which compares current assets with current liabilities, has improved over the last 5 financial years, it still remains just below 1. If entities are unable to pay debts as they fall due, they may need to rely on the state for financial support. The state's borrowings increased by $3.8 billion or 8.1% in 2013-14. At the same time, gross state product increased by a smaller percentage, resulting in the state having a reduced capacity to service borrowings. As the state's debt increases, so does the interest expense incurred to service the debt. This reduces the funds available for public services and the agility of the state to respond to revenue changes and unforeseen expenditure. We have made 4 recommendations in this report. The first 2 relate to Department of Treasury and Finance, known as DTF. We have recommended that DTF develops an appropriate and consistent accounting policy for economic obsolescence of public sector assets. DTF have not accepted this recommendation. The second recommendation relates to commentary in Part 2 of the report. We found that almost 80% of material entities which consolidate into the AFR did not complete their financial statements on time. This made the audit of the AFR difficult. We recommend that DTF works with material entities to improve the timeliness of financial statement preparation. In addition to these 2 recommendations, there are a number of other technical matters which we will be communicating to DTF in our final AFR management letter. We will be monitoring the status of these issues going forward. The next 2 recommendations relate to DECD. DECD have not formally accepted these recommendations. We recommended that it maps the requirements of all applicable Australian accounting standards to its underlying systems and records and identifies any gaps or limitations that prevent the preparation of a complete and accurate set of compliant financial statements, and critically reviews its financial report preparation processes to identify areas for improvement and implements all improvements before the 30th of June 2015. All our reports are available on our website at www.audit.vic.gov.au. If you have any questions about this or other reports, or if you have anything else you would like to discuss with us, including ideas for future audit topics, please call us on 03 8601 7000 or contact us via our website.